Today, we're doing a complete breakdown of IAS 16. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying international financial reporting standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine buying a $10 million machine, but each financial statement values it differently. IAS 16 standardized how businesses report property, plant, and equipment, ensuring consistency and comparability across financial statements. After this section, you'll understand why uniform asset valuation is essential and how it impacts financial reporting. IAS 16 exists to bring consistency in accounting for property, plant, and equipment. Before its introduction, asset valuation methods varied, causing discrepancies in financial reporting. For example, one company might depreciate a $2 million asset differently than another. IAS 16 solves this by providing standardized guidelines, ensuring assets are valued and reported consistently. Understanding this standard helps in comparing financials across companies effectively. All companies using international financial reporting standards must comply with IAS 16. Effective from January 1983, this standard mandates that property, plant, and equipment should initially be recorded at cost, including related expenses such as installation. Consistency in accounting policies is crucial. For instance, revaluation can significantly alter a company's financial ratios, impacting investor perceptions. Mastering this requirement is crucial for accurate financial analysis and reporting. IAS 16 offers two models, the cost model and the revaluation model. The cost model keeps assets at their initial cost, less depreciation. In contrast, the revaluation model periodically adjusts assets to reflect fair value. This choice can significantly influence reported asset values and company financials. Mastering these models is essential for interviews, demonstrating a deep understanding of how asset valuations impact financial reporting and decision-making. Understanding scope is critical. A common pitfall is misclassifying investment property as PPE, which falls under IAS 40. Interviewers often bait candidates with these traps. Knowing what IAS 16 covers or excludes can change how you report millions in assets. Grasping these distinctions is more than academic. It's essential for accurate financial reporting. IAS 16 governs tangible assets like machinery and equipment in production, from factory conveyors to service delivery trucks. Assets held for rental are also within scope, such as leased office equipment. Understanding what this standard applies to ensures you record asset depreciation correctly, impacting everything from cost structures to profit margins. For example, a fleet of leased trucks must be depreciated systematically to align with revenue generation from deliveries. A crucial aspect of IAS 16 is what it excludes. Investment properties, for instance, are dealt with under IAS 40, impacting valuation methods significantly. Biological assets linked to agriculture, such as livestock or crops, fall under IAS 41. Excluding intangibles like patents is another key differentiation. They're accounted for under IAS 38. Each exclusion has its own standard, ensuring assets are valued and reported correctly, avoiding misstatements in financial reports. Property, plant, and equipment, or PPE, are tangible assets integral to business operations. Think of the machinery in a factory or vehicles for deliveries. These are not just line items, they are crucial for revenue generation. Take an office building, for instance. It's a long-term asset, requiring systematic depreciation to reflect its decreasing value over time. Misclassifying assets like these can lead to significant financial misstatements, affecting everything from asset valuation to profitability. Depreciation is the systematic allocation of an asset's cost, such as a factory machine, over its useful life. Imagine a delivery truck with a 5-year life. Each year, a portion of its cost reflects wear and tear. This impacts not just the balance sheet, but also the income statement, influencing profit margins. Properly accounting for depreciation ensures that financial reports accurately reflect an asset's reducing value and the business's operational costs. Scope can get tricky with IAS 16. Consider leasing out a factory. The asset's depreciation impacts your rental income. Solar panels on a company's property? They're PPE and must be depreciated. Land improvements like paving fall under IAS 16, influencing asset value. Even leased IT systems, if they support operations, need systematic depreciation. These edge cases often trip up interviewees, but knowing them ensures accurate reporting and compliance with financial standards. When a company invests millions in assets, precise valuation is key for transparency and decision-making. The core model, including the cost and revaluation methods, ensures assets reflect true value on the balance sheet, supporting investor trust and strategic planning. The cost model and revaluation model offer a structured path for asset valuation. Meridian Corporation's $10 million SaaS contract with Acme Incorporated will illustrate this. We'll see how the $8 million software and $2 million implementation services are accounted for, reflecting the asset's true value across its lifecycle. Meridian Corporation begins by determining the cost of its $10 million SaaS contract with Acme Incorporated, initially capitalizing the $8 million software license. This cost reflects all expenditures necessary to bring the software to operational condition. A common pitfall is missing indirect costs, which can understate asset value. Ensuring comprehensive cost inclusion sets a strong foundation for subsequent valuation steps. Building on Step 1, Meridian Corporation decides on the cost model to handle its $8 million software asset. This choice ensures consistent depreciation without frequent revaluations, aligning with their strategy for predictable reporting. A common mistake is not matching the model to strategic goals, which can disrupt financial plans. By opting for the cost model, Meridian Corporation maintains clarity and stability in asset valuation. With the cost model chosen, Meridian Corporation now assesses the software's useful life. For their $8 million investment, a 3-year lifespan matches the contract duration, ensuring aligned depreciation schedules. A frequent misstep is overly optimistic estimates, which can skew financial results. By aligning useful life with contract terms, Meridian ensures depreciation accurately mirrors asset utility. Meridian Corporation now calculates depreciation on its $8 million software using a straight-line method over 3 years, as per the useful life assessed earlier. This results in a consistent annual depreciation expense, supporting stable financial reporting. Missteps often arise from unsuitable methods that misrepresent asset usage. By choosing straight line, Meridian ensures clear and predictable financial outcomes. Meridian Corporation wraps up the asset lifecycle by reviewing its software for impairment. They ensure the $8 million carrying amount remains valid against recoverable value. A common oversight is neglecting market shifts or tech changes that affect value. Regular impairment reviews are crucial to uphold asset accuracy and avoid financial misrepresentation. This vigilance keeps the balance sheet true to the asset's actual worth. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Deciding between cost and revaluation models is crucial, and so is disclosing the method and assumptions used. Understanding these choices ensures that stakeholders can trust the numbers presented. Assets are initially recognized when it's likely they'll bring economic benefits, and they're measured at cost. This includes not just the purchase price, but also any directly attributable costs. Remember that recognition happens when controlled transfers, not just when you make the purchase. This can be critical during year-end accounting. After initial recognition, you have 2 choices: cost model or revaluation model. With the cost model, assets are kept at cost minus depreciation and impairment. Revaluation, however, adjusts carrying amounts to fair value, impacting equity through surplus or deficit. For volatile assets, frequent revaluation ensures accurate representation. This choice affects reported asset values and equity. Assets from IAS 16 appear on the balance sheet as property, plant, and equipment. Depreciation is a key expense shown on the income statement. In the notes, disclose revaluation surplus or deficit and the valuation techniques used. Classify assets based on their nature and usage. Clear classification ensures stakeholders understand asset allocation and utilization. Disclosures under IAS 16 include the measurement basis, which is vital for transparency. Depreciation methods and rates reveal how asset value is consumed. detailing revaluation surplus aids in assessing asset value changes. A reconciliation of carrying amounts shows stakeholders exactly how asset values evolved, enhancing trust and clarity in financial reporting. Imagine the CFO of a company with a $10 million building opts for revaluation. This decision increases the asset's value to $12 million, creating a $2 million revaluation surplus. Future depreciation now impacts earnings differently, affecting key financial ratios. Disclosures about the method and equity impact offer transparency, crucial for investor confidence. Meridian Corporation, a global manufacturing company, acquires a new production machine for $1,200,000. Explore how this investment influences its financial reporting. From initial recognition to eventual disposal, each step reveals the intricacies of IAS 16 compliance. The new machine is recorded as an asset on the balance sheet under property, plant, and equipment at its purchase cost of $1,200,000, as mandated by IAS 16. This entry doesn't affect the income statement immediately, but increases the company's total assets and decreases cash. Under IAS 16, Meridian Corporation must allocate the machine's cost over its useful life. The $120,000 annual depreciation expense reflects the wear and tear of the asset and impacts the income statement, reducing profits. The cumulated depreciation grows on the balance sheet, showing asset value consumption. Recording annual depreciation again decreases net income by $120,000. Maintaining compliance with IAS 16. This continuous allocation ensures each financial period reflects the asset's usage, affecting both the income statement and the growing balance of accumulated depreciation, now totaling $240,000. Under IAS 16, revaluation models allow the adjustment of assets to fair value. The $100,000 increase enhances the machine's carrying amount, raising total assets without impacting the income statement. The revaluation surplus appears in equity, reflecting unrealized gains on the balance sheet. IAS 16 distinguishes between capital improvements and maintenance. Maintenance costs like this $20,000 ensure operational functionality and are expensed directly, reducing net income. Unlike capital expenditures, these costs don't increase asset value but reflect necessary operational spending. IAS 16 mandates impairment recognition when asset carrying amounts exceed recoverable amounts. The $50,000 impairment loss decreases asset value directly, reflecting diminished future economic benefits. This loss impacts both the income statement and the asset's book value on the balance sheet. Disposal of assets under IAS 16 involves removing the asset's carrying value and recognizing any proceeds. The $950,000 from the sale enters as cash, closing out the asset's book value. Any difference between the sale proceeds and carrying amount affects profit or loss, finalizing the asset's life cycle. Every Big Four and investment bank interview on IAS 16 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. IAS 16 prescribes how to recognize, measure, and disclose property, plant, and equipment, PPE. It ensures consistency and transparency in financial statements, crucial for stakeholders. Interviewers often hear vague answers. Focus on how it impacts decision-making by providing reliable data. Remember, consistency in PPE valuation is key to comparing financial health across companies. IAS 16 allows straight-line, diminishing balance, and units of production methods for depreciation. The selected method should reflect asset usage. Consistent application is critical. Candidates often confuse methods. Remember, straight-line results in equal charges, while diminishing balance accelerates expense. For example, a $100,000 asset might depreciate $10,000 annually straight-line, but more initially with declining balance. The cost model keeps assets at historical cost minus depreciation. The revaluation model adjusts to fair value at each reporting date, minus subsequent depreciation. Common errors involve mixing models. Never forget, using the revaluation model affects equity, not just profit. Mastering this helps explain how asset management affects company value. Record PPE at cost, including purchase price, directly attributable costs, and dismantling restoration costs. Mistakes often happen by omitting directly attributable costs. For instance, a $1 million machine might include $50,000 in installation. Understand all costs impact initial recognition. Impress interviewers by detailing these components in acquisition scenarios. Indian accounting standard aligns closely with international financial reporting standards in PPE treatment. But subtle differences exist. For instance, under Indian accounting standard, revaluation surplus in OCI impacts deferred tax differently than international financial reporting standards. Misjudging these nuances can lead to financial misstatements. Knowing the precise impacts on financials helps in roles involving cross-border transactions. Assume a $120,000 machine with a 10-year life and no residual value. Straight-line depreciation is $12,000 annually. Errors occur when life or residual value is misestimated. Key takeaway: ensure assumptions are realistic and consistently applied to reflect true economic consumption of the asset. IAS 16 excludes assets held for sale, biological assets, and exploration assets. Common mistakes involve misclassifying such items. Recognize that each category follows specific standards. For example, International Financial Reporting Standards 5 for held for sale. Mastery here shows you understand asset categorization, critical for accurate financial reporting and compliance. Disclosures include asset measurement basis, depreciation methods, useful lives rates, and reconciliation of carrying amounts. Commonly, candidates overlook the reconciliation requirement. Ensure you mention how these disclosures provide transparency and facilitate analysis, aiding stakeholders in assessing the company's capital investment efficiency. Revaluing PPE increases asset value, impacting deferred tax. The revaluation surplus affects OCI, not profit, yet deferred tax arises from temporary differences. Candidates often miss this linkage. Understand the tax effect from revalued assets to impress. It highlights your grasp of complex accounting intersections. IAS 16 guides the accounting for property, plant, and equipment, focusing on their initial recognition, depreciation, and derecognition. It applies to tangible assets like machinery and buildings, ensuring they are accounted for separately when significant parts differ in useful life. Understanding the concept of residual value, depreciable amount, and useful life is crucial for accurate financial reporting. IAS 16 provides two models for measuring assets. The cost model, where assets are held at cost minus depreciation, and the revaluation model, where they are adjusted to fair value. Choosing the right depreciation method is key, reflecting the asset's economic use. Regular impairment testing and revaluation ensure accuracy, with revaluation surplus appearing in other comprehensive income. Understanding IAS 16 is crucial for roles involving asset management. Key areas include componentization to avoid incorrect depreciation, differences from U.S. generally accepted accounting principles where revaluation isn't allowed, and thorough disclosure requirements. Regularly reassess useful lives and capitalize borrowing costs accurately. Ensure revaluation frequency aligns with market conditions, and classify spare parts correctly. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.